Welcome back to another explainer. Today, we're diving into what is honestly one of the most fascinating and dramatic transformations we've seen in the tech sector in a long time. Remember when Dell was just that bulky, standard-issue PC humming under your desk at work? Well, you can completely forget that image. Dell has rapidly evolved into a critical, high-powered AI infrastructure giant. And as they gear up for their crucial May 28th earnings report, there's this massive, multi-billion-dollar financial tug-of-war happening behind the scenes. We're going to break down the data to see exactly how they pulled this off and what major challenges are lurking just around the corner.
So here is our roadmap for today's explainer. First, the setup, the $43 billion backlog. Second, unpacking the bull case. Third, the bear case constraints. And finally, number 4, the May 28th scorecard.
Okay, let's dive right into this with Section 1, the setup, the $43 billion backlog.
To really wrap our heads around the sheer jaw-dropping scale of Dell's current financial reality, you just need to look at this number, $43 billion. That is Dell's record-breaking AI server backlog as they exited fiscal year 26. Just to put that immense scale into perspective for a second, Dell's management previously guided for $50 billion in AI server revenue for the entire fiscal year 27. Think about that. This contracted $43 billion backlog alone, literally without them booking a single new deal in the coming year, already covers roughly 86% of that massive $50 billion guidance. It's wild. It's the largest contracted server pipeline in the company's entire history.
And we can clearly see this explosion in the data. In just the fourth quarter of fiscal 26, Dell's AI-optimized servers hit $9 billion in revenue. That represents an absolutely explosive 342% year-over-year growth. If they simply held that current run rate flat, we're talking $36 billion a year. But their guidance actually implies this run rate is going to ramp up even further throughout the year. They aren't just participating in the AI boom, they are aggressively cementing their scale right at the very center of it.
All right, let's move on to Section 2, unpacking the bull case.
So why exactly is Dell winning so massively? I mean, they're growing their infrastructure group at 40% year over year, while competitors like HPE and Cisco are trailing in the single digits. Well, the first big reason is their incredible roster of anchor AI customers. Dell has successfully shifted from being a simple transactional hardware OEM into a strategic AI factory builder. They're locking down these multi-billion-dollar mega deals. We're talking the xAI Colossus expansion, the massive open AI-led Stargate project, and they just closed a $117 million deal for the NVIDIA-anchored Pangea-5 supercomputer. And here's why this is an absolute game changer. These aren't just one-off hardware sales. They include deployment, managed services, and ongoing platform support, which creates this incredibly vital, sticky layer of recurring service revenue for Dell.
Now that momentum is bleeding right into another fascinating, rapidly growing category, sovereign IA. If you haven't heard this term, sovereign AI essentially refers to governments, defense, and highly regulated industries buying up massive AI infrastructure. But because of who they are, they require extremely strict geographic data residency, heavily certified supply chains, and defense-grade security. Dell is perfectly positioned to deliver exactly this. We're seeing countries like France, the UK, Saudi Arabia, and Japan launching sovereign IA initiatives. And get this, each of these deals is typically $1 billion or more in infrastructure scope alone. It's a massive, high-security growth engine.
And beyond governments, there's the incredibly lucrative edge AI inference market. While everyone is super focused on these massive centralized training clusters right now, the next major wave is edge AI. This means deploying these trained AI models locally, right inside an enterprise's own data center, a local branch office, or even directly in a retail store. Dell's PowerEdge servers and their AI Foundry framework position them perfectly to capture this next massive phase of deployment. To put a number on it, the total addressable market for enterprise edge AI inference is estimated to hit $100 billion by 2030.
But what's really interesting here, the true ultimate moat protecting all of this growth, is Dell's deep strategic partnership with NVIDIA. We're not just talking about a basic buyer and supplier relationship here. We are talking about joint customer engagement teams, joint reference architectures, and honestly, the biggest key, advanced visibility on GPU allocation. This level of deep operational integration heavily differentiates Dell from the second-tier server OEMs, who are basically just stuck waiting in line hoping for chips.
Okay, but we have to look at both sides of the coin. Let's shift gears to Section 3, the bear case constraints.
Because in the hardware world, massive revenue does not automatically mean massive profits. And the first major constraint for Dell actually comes from inside their own house. There's a really striking internal contrast going on. On one side, you have the ISG, the Infrastructure Solutions Group covering servers, booming at 40% year-over-year growth. Incredible, right? But on the other side, you have the CSG, the Client Solutions Group, which handles their commercial and consumer PCs. That division is remaining essentially flat, if not slightly down, mostly due to cautious IT budgets. The core challenge here is that PCs still make up 40 to 45% of Dell's total revenue mix. So this flat PC division acts like an anchor, dragging down the blended growth of the entire company, even while the server side is absolutely exploding. Which naturally leads us to the single most contested debate surrounding Dell right now. As the quote lays out, revenue growth materially outpaces operating income growth. AI server gross margin is structurally low single digit. So what does this actually mean in plain English? Basically, yes, Dell is selling billions upon billions in AI servers, but they are largely just passing through the incredibly expensive bill of materials for those NVIDIA GPUs. That dynamic heavily squeezes their operating margins, creating this really frustrating gap between their top-line revenue expansion and their actual bottom-line earnings.
Add to that another major headache: the bottlenecks. Specifically, their total dependency on NVIDIA GPU allocation and some seriously intense working capital tightness. Think about it. Dell's incredible $43 billion backlog means absolutely nothing if NVIDIA's supply suddenly tightens up, maybe because of manufacturing constraints over at TSMC or complex packaging bottlenecks. Plus, Dell has to finance all of this high-value, long lead-time inventory up front, while their mega-deal enterprise customers are often demanding extended payment terms. That combination puts a really serious squeeze on Dell's free cash flow.
And let's not forget exactly who Dell is fighting out there in the trenches. The competitor landscape is fierce. You've got Supermicro offering faster custom configurations at lower margins. HP is out there pushing their supercomputing specialization. Cisco is investing heavily in AI networking. But really, the true structural long-term threat comes from the hyperscalers. Giants like Google with their TPU v6 and AWS with Trainium are increasingly shifting towards using their own in-house custom silicon rather than buying traditional x86 servers packed with GPUs. As those hyperscalers shift their massive capex, their own proprietary chips, the total available market for companies like Dell naturally starts to shrink.
Finally, let's quickly run through the broader macro risks hanging over the tech sector right now. What happens if this massive AI spending bubble slows down? The Magnificent Seven hyperscalers are guiding to spend over $680 billion in AI capex. If that peaks and enters a digestion period, Dell's backlog conversion could slow significantly. Add to that potential 8 to 15% cost pressures from tariffs on Asia-sourced components, and the very real fact that a lot of Fortune 500 enterprises are currently struggling to prove actual return on investment for their shiny new AI pilots. If enterprise adoption stalls out, Dell's mega pipeline could suddenly compress.
So, how do we measure who is winning this tug of war? Let's hit Section 4, the May 28 scorecard.
It is time to translate all of this abstract financial theory into the concrete checklist the market is fiercely watching. Here are the 5 absolutely crucial metrics Dell's management must deliver to prove they are a long-term compounding machine. First, they need Q1 revenue to hit the high end of their guide, right near $35.7 billion. Second, they have to prove they can actively convert that massive backlog, meaning $10 billion or more in Q1 backlog conversion. Third, that ISG operating margin must hold at 11% or above, despite all that AI server mix pressure we talked about. Fourth, they need to show visibility that their PC division is finally recovering, hopefully thanks to the upcoming Copilot plus AI PC ramp. And fifth, they need to show they can refill that $43 billion mega-deal pipeline. Missing literally any of these 5 steps will instantly reignite the fierce debate over their profit margins. Which leads us with the ultimate $43 billion question. Is Dell's incredible momentum from Q4 the start of a multi-year, unstoppable operational compounding machine, or was it just a one-time peak driven by a few massive anchor customers that they simply won't be able to replicate going forward? That is the exact dilemma the upcoming May 28th earnings report will ultimately have to answer. Thank you so much for joining me for this explainer. Keep learning, and I'll see you next time.